You are 78 years old. It is a Tuesday morning in May 2026. You are standing in the kitchen you have stood in for 41 years. The coffee mug your granddaughter painted in third grade is warm in your right hand. The sunlight is hitting the same patch of linoleum it has hit every May since the Carter administration. 41 years of mortgage payments, 41 years of property tax checks written by hand, 41 years of arguing with the HOA, patching the roof yourself, raising 3 kids, and watching them raise their own kids inside these exact 4 walls. This house is not a house. This house is 41 years of compressed American life. It is worth $400,000 on paper. It is worth infinity in your chest. And then your left arm goes numb. You hit the floor before your brain even processes what is happening. Your wife is upstairs. She hears the sound. She calls 911. By 11:47 that morning, you are intubated at the regional hospital. By Thursday, the neurologist is using phrases like permanent deficit and 24-hour supervision and long-term care facility. Your daughter, the one who lives in Atlanta, drops everything and flies in. She sits in a beige conference room with a social worker who slides a glossy folder across the table. 3 memory care facilities within driving distance of the family home. She opens the folder. She sees the number. $12,500 a month. Not a year, a month. She does the math in the parking lot. $12,500 times 12 months is $150,000 a year. The facility down the road in Tampa is $14,000 a month. The one in Naples is $15,200. The Dementia Secure Memory Care Unit in Cincinnati is $13,800. Your daughter is a third-grade teacher. She makes $58,000 a year before taxes. She cannot do this. Your son in Phoenix is a contractor, overextended on 3 projects. He cannot do this either. Your wife's pension, your Social Security check, your modest IRA, none of it comes close. So she does what every American daughter does in that parking lot. She Googles how to get Medicaid to pay for nursing home. And that is the exact moment the trap closes. Here is what nobody told her. Here is what nobody told you. Here is what your financial planner, the guy in the navy blazer who sold you the variable annuity in 2014 and bought you a $4 coffee twice a year while calling it an annual review, never mentioned in 12 years of relationship. Medicare pays exactly 0 for long-term custodial care. 0. Nothing, not a single dollar. Medicare, the program you paid into every single paycheck for 40 years, the one with the friendly commercials showing silver-haired couples kayaking through sunlit lakes, covers up to 100 days of skilled nursing rehabilitation only if you have been hospitalized for at least 3 consecutive midnights and only while you are showing measurable clinical improvement. The moment you stop improving, and an 80-year-old stroke patient stops improving, typically around day 22, Medicare closes its wallet. Permanently. Medicare does not pay for someone to help you bathe. It does not pay for someone to walk you to the dining hall. It does not pay for someone to make sure you do not wander out the front door at 3 in the morning in January in your pajamas. That is called custodial care. It is the most expensive category of human service in the entire American economy, and Medicare does not touch it, which leaves Medicaid. Medicaid will pay for the nursing home. All of it. But Medicaid is means-tested welfare, and to qualify, you, a 78-year-old man who worked since you were 14, who paid taxes for 64 years, who served 2 years in the Army, who never once asked the government for a single dime, you have to be poor, not modest, not thrifty. Poor. In most states in 2026, the asset limit for a single Medicaid applicant is $2,000. Your wedding ring is worth more than that. The savings account you opened at the credit union in 1981 has to be drained below the cost of a decent used refrigerator before the state will lift a finger. So the social worker, a very nice woman named Brenda, who has done this job for 19 years and carries the 1,000-yard stare of someone who has watched this exact scene play out 4,000 times, slides a form across the laminate table to your daughter. The form asks for add in 60 months of bank statements. 60 months. Every checking account, every savings account, every brokerage statement, every withdrawal over $500, every transfer, every birthday check to a grandchild, every wire to your son for the down payment on his condo, every dollar that left your possession since May of 2021. This is the Sakingin 5-year look back. Shh. This is the audit nobody warned you about. This is the IRS-style forensic accounting that the state Medicaid agency runs on a grieving family during the worst week of their lives. And in 2026, every state has automated this process. The human caseworker is mostly there to click approve or deny on a software recommendation. The algorithm is not looking for crime. It is looking for love. It is looking for every act of generosity you committed in the last 60 months and converting each one into a transfer penalty. You gave your grandson $30,000 for his wedding in October 2023. That is not a wedding gift. That is, according to the Pennsylvania Department of Human Services or the Texas Health and Human Services Commission, an uncompensated transfer. You quitclaim deeded the house to your daughter in 2024 because some guy on a radio show told you it would protect the asset. That is not estate planning. That is, in the cold technical language of 42 U.S.C. Section 1396 PC, 1, a disqualifying transfer. The state takes the dollar value of every disqualifying transfer, divides it by the average monthly cost of nursing home care in your state, and that number is how many months you are disqualified from Medicaid. Let me show you the math, because the math is where the horror actually lives. Average monthly nursing home cost used for penalty calculations in Florida in 2026, roughly $11,500. You gave your grandson $30,000 for the wedding. $30,000 divided by $11,500 is roughly 2.6 months. You are disqualified from Medicaid for 2.6 months. That means someone, you, your wife, your daughter, has to come up with $11,500 per month for 2.6 months before Medicaid will pick up a single bill. Roughly $30,000 in cash you no longer have because your grandson already spent it on a DJ, a cake-cutting service, and a honeymoon in Cabo. But it gets worse. You also transferred the house to your daughter in 2024. Tax-assessed value, $400,000. $400,000 divided by $11,500 is roughly 34.7 months. You are disqualified from Medicaid for an additional 34.7 months stacked directly on top of the wedding penalty. You are now looking at a notch 37-month penalty window, during which the state of Florida will not pay 1 penny toward your custodial care. The nursing home, which has its own in-house collections department that makes the IRS look like a charity, will send bills to your wife in your name for over $425,000 in care that your family cannot cover. The asset you transferred is technically owned by your daughter, and good luck unwinding that in probate court when your daughter is suddenly facing her own divorce and her ex-husband's attorney has noticed the house deed. This is what I call the nursing home trap. And it is not an accident. It is not a bureaucratic oversight. It is a feature, not a bug. The state knew exactly what it was doing when it wrote the look-back rules in the Deficit Reduction Act of 2005 and has tightened enforcement every single year since. The state is betting, in plain English, on your ignorance. Hit the like button right now, not at the end, right now. Because the only way YouTube shows this video to the next family standing in that parking lot in Atlanta or Tampa or Cincinnati at 2 in the morning is if the algorithm sees engagement. State governments rely on your ignorance of the look-back rule to balance their long-term care budgets on the backs of seniors who paid into this system for 60 years. The platform does not want this content trending, so hit that button. It costs you nothing, and it might save the next family who lands here on the worst night of their lives. Subscribe and flip the bell. Join this archive before the state places a lien on your family's home. And yes, we are absolutely going to get to liens, because the lien is the second act of this horror movie, and most people do not even know the curtain has gone up. Quick disclaimer, this is not legal advice. It is a survival guide for a system designed to take everything you spent 50 years building. Consult a licensed elder law attorney in your state. Now let us dissect the 3 layers of the trap, because if you cannot see the trap, you cannot avoid it. Layer 1. The Medicare Custodial Care Illusion. The federal government runs two programs with names that sound nearly identical, and most Americans, including retired CPAs, retired attorneys, and people who spent their careers explaining things to children, cannot reliably tell them apart. Medicare, Medicaid. One letter, different. Two entirely different universes. Medicare is the insurance program you paid into through FICA payroll deductions your entire working life. It is not welfare. It is an entitlement you earned. It covers hospital stays under Part A, doctor visits under Part B, prescription drugs under Part D, and managed care under Medicare Advantage. What it has never covered and will never cover under current statute is long-term custodial care in a nursing facility. Skilled nursing, yes, but only after a qualifying hospital stay of 3 consecutive midnights, only for up to 100 days, and only while you are clinically improving. Days 1 through 20 are covered at 100%. Days 21 through 100 carry a daily copay that in 2026 exceeds $200 per day. The moment your physical therapist documents that you have plateaued, and in an 80-year-old stroke patient you plateau, the entire bill flips to 100% your responsibility. Medicaid is the joint federal-state welfare program for the poor and disabled. It pays for nursing home custodial care indefinitely, but it is means-tested, asset-tested, income-tested, and administered by 50 different state agencies with 50 different rule books and 50 different attitudes toward enforcement. The lie is in the marketing. Look at the Medicare Advantage commercials flooding your mailbox the day you turn 64. Every single one shows healthy retirees kayaking, playing pickleball, hiking, walking grandchildren through autumn leaves. None of them show the statistical reality of American aging, which is that roughly 7 out of every 10 people who reach age 65 will need some form of long-term care before they die. The average nursing home stay exceeds 2 years. The median cost in 2026 is $300,000 to $400,000, and Medicare covers none of it. Layer 2, the 60-month audit. The 5-year look-back is codified at 42 U.S.C. Section 1396 PC. It is federal law, not state law, which means every state in the union enforces it. The statute says in plain English, when an individual applies for Medicaid long-term care benefits, the state shall examine the applicant's financial transactions for the 60 months immediately preceding the application date. Any transfer of assets for less than fair market value during that window is presumed to be a transfer for the purpose of qualifying for Medicaid and triggers a penalty period of ineligibility. 60 months, 5 years. Every checking account, every savings account, every CD, every brokerage account, every transfer over $500, in some states over $200. The Medicaid caseworker, and in 2026, it is really a software system the caseworker rubber stamps after a 6-minute review, pulls the full 60-month transaction history, and runs it through an automated transfer detection algorithm. Birthday checks to grandchildren, flagged. Tuition payments for a grandchild at community college, flagged. The down payment you helped your son with in 2022, flagged. The $2,000 you donated to the church capital campaign in several states, flagged. Let me give you 3 states, 3 completely different mechanical realities. Florida. Average monthly nursing home rate used for penalty calculations in 2026, roughly $11,500. Look-back window, 60 months. Florida has historically offered a generous homestead exemption. The primary residence is excluded from the asset count up to roughly $700,000 in equity while you are alive. But here is what Florida retirees miss every single time in that parking lot from Pensacola to Key West. The homestead exemption protects the house while you are alive. It does not protect it from Medicaid estate recovery after you die. The house is still on the table. The exemption just delays the seizure to the funeral. Ohio. Average monthly rate used for penalty calculations in 2026, roughly $8,500. Look-back window, 60 months. Ohio is one of the most aggressive estate recovery states in the country. The Ohio Attorney General's office runs the recovery program, and they are extremely good at their job. Ohio recovers from the probate estate, but Ohio also expanded recovery to certain non-probate assets, including jointly held property in some circumstances. If you added your daughter to the deed as a joint tenant in 2023 because someone at the kitchen table said it was easy and cheap and just as good as a trust, it was not. Ohio can see that. Ohio comes for that. California. California is the outlier in 2026, and I have to be precise here because the rules just changed and most content out there is still operating on the old playbook. As of January 1st, 2024, California eliminated the asset test for Medi-Cal long-term care entirely as part of the Cal AIM reforms. Read that again. California in 2026 does not impose a hard asset limit on most Medicaid nursing home applicants. The look-back is functionally narrower for most applicants. California also dramatically narrowed estate recovery back in 2017 to recover only from the formal probate estate, meaning that if you avoid probate with a properly structured revocable living trust, correct beneficiary designations, and appropriate titling, you generally avoid recovery entirely. California right now is the most retiree-friendly Medicaid state in the country, which is precisely why elder law attorneys in Nevada and Arizona are quietly fielding more calls than ever about establishing California residency for aging parents. The geographic arbitrage is real, it is silent, and it is happening this week. 3 states, 3 completely different realities, and nobody at the bank, at the doctor's office, at church, or at the senior center coffee hour is going to volunteer to walk you through which set of rules applies to your specific zip code. Layer 3, MERP, the recovery after death. Even if you succeed, even if you spend down your assets below the limit, even if you survive the look-back, even if you qualify for Medicaid, and the state finally begins paying your nursing home bill, the state is keeping the receipt. Every single dollar the state spends on your custodial care is logged in a ledger with your name on it. And the day you die, the state files a claim against your estate to recover every penny. This is the METS Medicaid Estate Recovery Program. MERP, mandated by federal law since 1993 under the Omnibus Budget Reconciliation Act. Every state must recover from the estates of deceased Medicaid recipients who received long-term care benefits after age 55. Must, not may. Must. What does recover mean in plain English? The state files a lien on the family home. The state submits a creditor's claim in probate court. When your children try to sell the house they grew up in, they cannot transfer clean title until the state's claim is fully satisfied. I want a field report from you in the comments. Tell me your age. Tell me your state. Tell me whether anyone ever has explained the difference between Medicare and Medicaid to you in clear English before today. Tell me whether your financial advisor mentioned the 5-year look-back in your last review. Tell me whether your attorney brought up MERP when you signed your will. I read every comment. I am building a map of where this education is failing, state by state, county by county. How old are you? And do you have a plan for long-term care that does not involve losing the house? Now let us talk about exactly how the state seizes equity, not in the abstract, but in the mechanical, document by document, court filing by court filing reality. The state does not show up at your door with a moving van. The state does not change the locks while your children are at the funeral. The state is far more patient than that. The state plays the long game. Step 1. You die. The death certificate triggers an automatic notification cascade. The Social Security Administration is notified, the VA is notified if you served, and the state Medicaid agency is notified because Medicaid maintains a recipient database and runs periodic cross-matches against death records. Within 30 to 90 days, the Medicaid Recovery Unit knows you are deceased. Step 2. Your family opens probate, either voluntarily, because they need to transfer the house, or because a creditor files a petition. The probate court issues letters testamentary to your personal representative, usually your eldest child, the responsible one, the one who already missed a week of work for the funeral, and is running on 3 hours of sleep and gas station coffee. That personal representative is now legally obligated to notify all known creditors. Step 3. The state Medicaid agency, having received the death notification, files a creditor's claim against the estate. The claim is itemized to the dollar: every nursing home day, every prescription, every covered service. In a typical case where a recipient was on Medicaid long-term care for 3 years at an average state cost of $10,000 per month, the claim is $360,000. $360,000, one number, one piece of paper, handed to your grieving son. Step 4. Your eldest child, now the personal representative, is in a fiduciary position. Under state probate law, they must pay valid creditor claims before distributing anything to heirs. Personal liability attaches if they distribute assets to family while a valid creditor claim is outstanding. The state's claim is valid, documented, and legally enforceable. There is no negotiating it to 30 cents on the dollar. There is no sympathetic congressman to call. There is no hardship waiver in most states, unless a surviving spouse or disabled child lives in the home. And even those waivers only delay the recovery. They do not cancel it. Step 5. The house, the largest asset in the estate, gets sold to satisfy the claim. The house your father bought in 1984 for $62,000. The house where your mother taught you to ride a bike on the driveway. The house where every Thanksgiving for 40 consecutive years happened. That house gets listed with a realtor, sold to a stranger, and the proceeds fund a $360,000 check to the state's General Revenue Fund. Whatever remains after broker fees, closing costs, and the state's claim, maybe $25,000 on a $400,000 sale, gets split among the heirs. That is the heist. That is the precise mechanics of how a working-class family that did everything right, paid the mortgage, raised the kids, never asked for a handout, voted in every midterm, loses the entire generational asset in the final 18 months of one parent's life. And here is the part that should put smoke out of your ears. The exact same family, same income, same assets, same kids. If they had executed a Medicaid Asset Protection Trust, commonly called a MAPT, 5 years and 1 day before that stroke happened, they would have lost nothing. Zero. The house would have transferred outside probate. The state would have had no claim to file because the house would not have been part of the probate estate. The children would have inherited everything. 5 years and 1 day. That is the entire difference between losing $400,000 and losing nothing. Send this video to one person right now. 1. Pick the friend who is holding the house for the kids. You know exactly who I mean. The widow who refuses to talk about wills because it feels morbid. The retired teacher who keeps saying she will deal with it next year. The neighbor who says his kids will figure it out when the time comes. That person. Send this today, not tomorrow. Today. Because the look-back clock starts ticking the day they sign the trust. Every single day they wait is another day inside the trap. One conversation now can save their family's entire legacy. Now let us talk about the actual instrument, the one legal structure the state cannot reach. The instrument is called a Medicaid Asset Protection Trust. MAPT. In legal terms, it is an irrevocable inter vivos trust, a trust you create during your lifetime that cannot be revoked. The irrevocability is the entire point. It is what makes the trust legally distinct from you as an individual. The state cannot count what you do not own. And the moment you transfer an asset into a properly drafted MAPT, you no longer own it. The trust owns it, and the trust is not you. Save this video right now, bookmark it, add it to your private library, because what comes next is the exact sequence of documents and decisions that determines whether your family inherits $400,000 or walks away with $25,000. This is the document checklist your elder law attorney should be walking you through right now. And if you do not have an elder law attorney, the existence of this checklist is itself the evidence that you need one. Asset 1, the primary residence. The home is almost always the largest single asset and the most emotionally complicated. Your elder law attorney drafts the trust agreement. The trust is established as a separate legal entity with its own federal tax identification number. You transfer the deed from your personal name into the trust through a properly recorded deed in the county where the property sits. You typically retain what is called a life estate or a retained right of occupancy, meaning you continue living in the home for the rest of your life. The trust owns the property. You occupy it. The state cannot count it because you do not own it. And because the trust is irrevocable, the state cannot argue you can simply take it back. The clock starts ticking on the 5-year look back the day that deed is recorded. Not the day you call the attorney, not the day you sign the retainer, the day the deed is recorded in the county land records. Every day you wait is a day inside the trap. Subscribe to Senior USA Hub for more content exactly like this, because this is the conversation nobody in the system is going to have with you. Not the bank, not the doctor, not the financial planner in the navy blazer. This is your survival guide. Use it.